Hello, everyone. Everyone, today on the final bar, we'll talk about this market environment, selling off right out of the open, really progressing higher through the course of the day, the afternoon, really pushing the S&P almost back to the zero level, finishing a little bit below even, but certainly a weaker day with a lot of distribution. Healthcare, the big winner today. We're going to look at that sector in a little bit of detail. Also, some of the other key themes to pay attention to on macro sectors and stocks. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of stock charts, using the technical toolkit to better understand investor behavior, and doing that by focusing on the message the markets give back to us in the form of price and breadth and sentiment. There is no crystal ball to know what's going to happen next in the markets, but there are a set of tools to help you better understand market dynamics, and price can tell you a great deal. That's what John Murphy and Martin Pring and Edwards and McGee and early authors that many of us read as we were first learning about technical analysis. That's what they stress to all of us, is the message, the information that's embedded in price. And at times that has been a sort of a heretical thing, or a less popular way of approaching things. That has changed a great deal. And over the years, the growth in hedge funds, the growth in behavioral finance is all further validated what some of those early technical traders and investors had figured out long ago. So let's continue to look at the markets using their very successful toolkit called technical analysis. We have fantastic guests on the show. I had a lot of fun last week with some of our guest discussions, just understanding how they were approaching the markets. This week, we have three great guests for you. Tomorrow, on Tuesday, the 11th, Bill Baruch from Blue Line Futures is joining us for the first time. On Wednesday, the 12th, Dana Lyons from J Lyons Fund Management. On Thursday, the 13th, Mary Ellen McGonigal from MEM Investments coming back on the show. Next week, on Tuesday, the 18th, we have Andrew Thrasher from Thrasher Analytics. Also, as a heads up, I'll be taking this Friday off, but our friend Erin Swenlin has agreed to guest host the show. Super excited. Erin's fantastic, has a really solid toolkit. She came on our show last week and gave a couple comments. So very thrilled to have her join and host the show this Friday. A couple other quick announcements for you as well in terms of upcoming events on Stock Charts TV. This Thursday, the 13th, 4 p.m. Eastern, Martin Pring and Bruce Frazier will be giving you their 2022 market outlook. Martin Pring literally wrote the book on cycle analysis, on seasonal trends, on really understanding market structure and asset allocation. So it'll be a lot of fun to hear what he is looking at through the course of this year. Our special series called Charting Forward 2022, which we enjoyed doing last year. We're doing again this year, having 6 different guest commentators and really effective analysts: Samantha Leduc from Leduc Capital, Linda Raschke from the LBR Group, Gina Martin Adams, Tony Dwyer, John Markman, Jay Woods. It's going to be a really cool set of discussions, all of them giving their outlook for 2022. Go to stockcharts.com/2022 market outlook for more info on that special. Finally, this week, I'll be giving a special presentation for the Money Show. I'll be doing a presentation called 7 Questions to Ask Before Every Trade. I'll share with you my technical toolkit, how I use it to actually break down investment decisions, and we'll look at a series of examples to try to make sense of things. It's coming up this Thursday, the 13th, at 12 p.m. Eastern, just after that. And if you go to stockcharts.com/money show, you can sign up for that event. Let's continue on today with our market recap. So Monday's show sort of has 3 main pieces. First, we start big picture. We look at the macro environment. Second, we looked at sector setups. And then third, we look at shifting stocks, individual stocks and themes, and movements around the equity market. So starting at the big picture, the S&P sort of a V-shaped day to the last trading session here. Friday really finished the day off in a choppy, sort of weaker tape. Today really opened strong to the downside, very much a risk-off feel to things. By the end of the day, the S&P had regained a lot of that and got above the opening price. Didn't quite make it back to Friday's close. We ended the day around 46.70. That's just below where we finished today on Friday, but overall ended up sort of an unchanged session for stocks, obviously with a lot of volatility along the way. NASDAQ finished a little bit in the green, and the Dow finished down almost 0.5%. The VIX, by the way, back above 19 to 1937. Other asset classes very quickly. Interest rates higher and moved higher through the course of last week. 10-year yield actually got above 180 earlier in the day today, but finished just below that around 178. And the dollar index is moving a little further to the upside. Gold and silver both higher today. The commodity complex as a whole a little weaker, with the DBC down 0.5%. Cryptocurrencies, I would guess I would describe this as sort of mixed. The chart of Bitcoin looks a lot like a chart of the S&P, sort of weaker earlier in the morning, but then by the afternoon, by the end of the equity trading session, getting back above 40,000, and Bitcoin is nearing 42,000. Ethereum has bounced around that 3,000 level. We talked about the importance of big round numbers, and Ethereum over the weekend hit 3,000, bounced off of there yesterday, and then earlier today got just below there before rallying back to the upside. So it could be that you're finding some of these major coins finding support at key levels. Bitcoin around 40 to 42,000, Ether around 3,000. So maybe very important to watch those charts to see how things potentially play out. Let's start with the market trend model. We talked about this on Friday, and just to confirm on the weakness going into Friday's close, that confirmed a bearish signal for my short-term model. My model has 3 time periods: short-term, a couple days to a couple weeks; medium-term, a couple months to a couple years; long-term, beyond a couple years. And long-term, medium-term remain overall very positive, and that makes sense, not too far off of all-time highs. But the short-term model just turned negative for me on Friday, and I update that every Friday's close. I try not to tinker with it or look at it too much during the week. Although I look at the chart, I try not to think too much about whether or not there's a change in the signal. It's more about looking every Friday to see how the long-term trends are shifting. And what this means overall is long-term still very, very strong. The medium term, which is sort of my main risk on and risk off measure, still very strong. The short term, just giving you short-term weakness, has been triggered. Now, what's interesting today, if you look at today's trading session, this is what's called a hammer candle. This is when the open and the close are very near the upper end of the range, where you have a long lower shadow or a long wick going to the downside. I have a chart style that allows you to focus a little bit on the current. You can see what happened here. So we hit the 50-day on Thursday of last week. We actually closed almost right exactly on the 50-day moving average on Friday's session. Today we opened below it. We opened down here just below 46.60. Traded down to 45.80 by the close. We'd eclipsed today's open, which gives it that hammer candle. And a hammer candle, think of it like a hammering out a bottom, right? It's sort of a short-term sell-off. You have this, earlier in the day, you have distribution, but by the close, enough buying power has come in to elevate the candle back up to above the opening price. And so overall, this is a short-term bullish indication. Actually indicates that there's some short-term demand, and certainly you saw that through the course of the trading day, right? We opened weaker, but during the course of the day, things got stronger and stronger. So overall, it's giving a short-term bullish signal for the S&P 500. Now, the broader picture are a series of concerning issues, right? You have the S&P going higher November into December, but the momentum overall has been weaker. These last couple times, as the S&P has attempted to get above to new highs and then has achieved new all-time highs, you can see that the momentum has remained, the RSI has remained for the most part below the 60 level. And in general, when you have an extended bull market phase, the range for the RSI sort of becomes elevated, and you tend to become overbought when the chart moves higher. When you pull back, the RSI tends to remain above 40, and that change, when you finally stop finding support at 40, a lot of times that can give you an early warning that things are starting to change a bit. There's a change of character in the chart. Look at how on this last rally higher, or the last couple in December and end of December, you saw that the RSI remained below 60. And that's more characteristic of a bear market phase than a bull market phase. When I'm looking at the chart of the S&P, that's kind of what's coming to mind for me. Just to finish off this discussion of macro, the macro environment, I mentioned this. I probably will keep mentioning this until I change my mind. But overall, I think the most important chart, besides the chart of the S&P, to understand what's going on is this chart, the 10-year yield. I think we've talked a lot about interest rates in previous years, but now as the Fed is starting to change policy, now as investors are starting to recognize that and reflect that in their positioning and in the flows of funds, I think you're going to find interest rates are more and more important. If you look at the performance of growth versus value, if you look at the performance of financial stocks or technology stocks, a lot of that can be attributed to the shape of the yield curve and particularly interest rates. So look back during historical periods when rates have gone higher and think about what types of stocks do well in that environment, what types of stocks start to struggle. And if you look in recent weeks and recent months, you'll see that plays out pretty well with the traditional playbook of a rising rate environment. So rates, moving higher last week, didn't get a bunch of upside move today. It was sort of drifting higher through the course of the or overall at the end of the day, but did get back above 180, which again is the highest levels we've seen in a couple of years, going back to February, March 2020. Let's continue on with our next segment called sector setup. So we look at the 11 S&P sectors, think about how they're rotating. Now, just to start with what happened today, sort of an interesting day because you only had one of the S&P sectors really up to any meaningful degree, and that was the healthcare sector, up 1%. If you look at the stocks that actually gained today, it's things like Moderna and Hologic and let's see, Bristol-Myers. I was thinking that was a bank, but that's the wrong ticker. BMY. You have a number of in the top 5, top 10. You have a number of healthcare stocks that bounce pretty well. There's some news there for Moderna and others that are causing prices to go higher, but it's interesting to know this is a sector that overall has not been the best sector on a relative basis. We've been talking a lot about many other sectors that overall have just had much better technical setups, but today, for what it's worth, healthcare, the one that got it done. Technology essentially flat for the day and had a nice move up to lock in that lack of a loss, I guess is how I would describe it. Otherwise, there was a lot of sectors that were down and nothing down significantly, just like there are no huge gainers, no huge losers today by the end of the day. But the cyclical sectors, industrials and materials, were at the bottom of the list, followed by some of the more defensive sectors like consumer staples, utilities, and real estate. Energy and financials, two sectors we've talked about a lot, which I think are continuing to be emerging leadership, sort of in the middle of the pack there, down about 1/3% from Friday's close. Let's look at the RRG. This is the relative rotation graph. And if you've not watched the show on Monday, we always refer to the RRG when we're talking about sector rotation. I think it's a beautiful visualization that shows how the sectors, or really any asset classes, any particular tickers, are rotating around a benchmark or one, something that you have in the middle. So here we're having the S&P 500 in the middle of the crosshairs. We're looking at the 11 S&P sectors and how they're rotating around that benchmark in the middle. We're using weekly data, so it's a little more of a longer term view, and that's how I tend to like to look at the RRG to start with, because it gives you a good sense of the overall trends and how they're evolving. What's really cool is that we can put this into motion. And if you look at consumer discretionary, which is now in the weakening quadrant, had been in the leading quadrant for quite some time. So if you look over the last 6 weeks, look at how, as I rewind and then fast forward, look at how the XLY has rotated down. Now no longer in the leading quadrant. Only 4 sectors in the leading quadrant today, and that's technology, which is very close to getting back in the weakening quadrant, just like consumer discretionary. The others are real estate, materials, and consumer staples. Consumer staples is one of those sectors that a lot of people have either forgotten about or just mentally written off for very good reason. For the longest time, consumer staples have been a perennial underperformer. So I don't blame you for not thinking a lot about some of those stocks. However, when I did a screen for stocks making new swing highs last week, I think I did it on Thursday, a lot of staples names coming up in that list, much more than usual. On average, very few staples names would be on the new swing highs list, making new 3-month highs. But it was a bunch of things, and it's things like Clorox and Campbell's Soup and TAP that are rotating above shorter term resistance levels, but others like Mondelez, MDLZ, Church Dwight, Bunge BG. I mean, all of these are sort of hitting resistance and eclipsing those. So an interesting space to watch for sure. Down a little bit today, but overall the trends appear to be rotating there. And as you can tell by the fact that consumer discretionary coming lower and consumer staples going higher makes me think of this chart, which is what I call offense versus defense. This is a chart that was inspired by a chart we had in the Fidelity chart room years ago. It was retired, but it was simply called offense versus defense. And it used 2 indexes that are no longer around. I forget what vendor actually had these, but it was essentially looking at the consumer space and seeing whether investors were rotating to the offensive side or the defensive side of consumer. Are they in consumer discretionary, things you want, or consumers staples, things you need? And it's a good proxy for risk on and risk off. And this was a very bullish indication in September, October, November of last year. On a cap weighted basis, on an equal weighted basis, you could see this ratio moving higher. And what that indicates is even if the S&P is struggling, if you have a choppy market environment, it still tells you that more investors are rotating to the offensive side of consumer. But look at how that's changed in the last 6 or 7 weeks. These are now rotating lower. Both of these have now undercut some previous swing lows, very close to undercutting lows from 2021 or from the middle of 2021 at the very least. And again, this is cap weighted at the top. And a lot of times that can be skewed to some of the mega cap names like Tesla and Home Depot and Amazon. But on an equal weighted basis, that literally just looks at all of those names in those two sectors and seeing where the rotations are. On an equal weighted basis, you're seeing investors rotate out of consumer discretionary and into consumer staples. And to me, that is very much more of a risk-off feel going into 2022. And again, so far as this year, still very early days, of course, but in the first week plus 1 day of trading, you're seeing it's rotating negative as well. So just more of a cautionary feel to this market. In terms of interesting rotations to hit on them, we'll look at a couple charts here very quickly. You have XLE rotating back northeast. You have the XLF rotating northeast. So on the daily RG, you'll see them far skewed to the upper right because you've certainly seen some strength and they're in the leading quadrant. On the weekly, though, it's been enough to rotate both of these back in a northeasterly direction. Interesting sectors to watch. We need to take a quick commercial break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So appreciate you joining us every weekday after the close. Thanks for being flexible with us. We had to rotate the airtime for the show during the week as we deal with some studio issues, but hope to get it back live for you at 4 p.m. Eastern very soon. Until now, you can watch it, of course, live at 6 p.m. or on demand at any time of the day or night. As a reminder, questions that we hit in our mailbag segment, we'll do another one of those on Tuesday's show, tomorrow's show. We get all those from you, our viewers. So questions that are coming up as you are analyzing charts, questions you're trying to answer as you're trying to use the technical toolkit. Let us help you make sense of these markets. So shoot us an email, thefinalbar@stockcharts.com. On Twitter, just tag us in a comment at FinalBarSCTV. On our YouTube channel, put a comment below the video that you're watching. We'll gather all those questions. Hope to answer one of yours on the air on Tuesday's show of this week. Also, our on-demand platform is really well done. I'm super proud of the team and all the work that they've put in to make our content resonate visually and with great audio as well. Go to StockChartsTV.com to watch all of our shows, our guests, our special events on demand. On your mobile devices, just search on any of the app stores for StockCharts TV on demand. Let's continue on Monday's show with our next segment, Shifting Stocks. So we talked big picture about the market giving back some of those gains, a hammer candle on the S&P today, which suggests potentially some short-term positive bias here, given the rally that you saw going into the close. We talked about sectors and really the longer-term rotation into things like financials and energy, two sectors that tend to do well in a rising rate environment. And we also talked about some of the other things that we're seeing today in terms of strength in the healthcare sector, particularly some pharmaceutical names. Now let's look at some individual stocks and see what themes we can tease out. Now, when you look at what's actually happening today, here are the FanMag stocks. Earlier in the day, if I remember, I think all six of these, were in the red. And I think going into the close, you saw enough of a recovery in things like Alphabet and others to push this group of names sort of mix where you have half gaining and half losing. But, again, it's hard to imagine the S&P having any sort of sustained up move, I would think, unless you see these names start to participate. I could very much see a scenario where cyclical sectors like energy and financials outperform, where some of the growthier stuff like tech and communication services underperforms. And unfortunately, there's so much cap in some of these names that the benchmarks won't be able to do very well. So you could see a flat to down S&P, even though certain stocks are actually doing just fine. You saw that today with The S&P lower, but healthcare doing all right. So it's certainly worth paying attention to this basket of names because it has very clear implications for most investors, because all of us seem to have exposure to these names in some direct or indirect way, but also the weight that they have in the benchmarks and what that will tend to mean for things. I posted a note on social media, I think it was on Friday, basically saying I challenge you to justify owning Amazon over the last 12 to 18 months. And I stand by that from a technical perspective. A lot of the responses that I got, and everyone, thank you for responding to that, more from a fundamental, more from a big picture thematic point of view. Yes, it's a flat period within a long term of performance. Like I get all that. I'm not saying I can't fathom how a company like Amazon can thrive in this environment. It's more on the charts. If you are using the charts and having a disciplined approach to analyzing trend, particularly relative strength and price momentum, this is a stock with literally the absence of price momentum. You are looking at Amazon right now at the same level that it was in July of 2020. It's gone nowhere in 18 months on an absolute basis. On a relative basis, you've got absolutely crushed owning this stock from July of 2021 to where you're at now in early 2022. Excuse me. I'm in August, July, August of 2020 to where we're at now 18 months later. It's just been an absolute disaster in relative strength. So it's worth remembering, if you're thinking about a long-term position in something like Amazon, is it that worth it to own it when it's absolutely hurting you as an investor? And I think that's what the technical toolkit is designed to help you understand, to disconnect a good story, to disconnect a good theme, good potential for a stock, for a company versus the reality of the stock and what the chart has done. And you see plenty of indications, particularly the weakness in relative strength, that should have suggested well before today to be looking elsewhere for some opportunity. Now, it's interesting on the chart of Amazon today, as we switch gears and look a little shorter term, if we focus in on the candles, you can see similar to what we talked about in the S&P, you have a hammer candle, a bullish hammer candle. That's when you have a sell-off. You have the open and close near the upper end of the range. You have a big, drawdown during the day. And so that's the handle of the hammer. That's the head of the hammer. And overall, that suggests strength rather than weakness. And it's interesting that that's happening right at that blue line, which are the lows from this range. If you look at the last 6 months, Amazon's been trading for around 3,200 on the lower end, around 3,700 on the upper end. So is this indicating, with a bullish candle pattern right at price support, that we are at the weaker end of this mean reversion and potentially riding back to the upside? I could get the argument for that. Long term, though, I think this chart has a lot to prove before it appears to be any sort of good idea as a good technically oriented investment right now. Now, I mentioned healthcare doing very well today. And again, I think the challenge for a lot of healthcare charts is that they just haven't been doing well. Charts like Bristol-Myers, while the last 4 or 5 weeks have been fairly constructive, this is coming out of a pretty beaten down level. I mean, Bristol-Myers got down to around 53, now rotating back higher, regaining the 50-day early December, regaining the 200-day after stalling there in mid-December, finally on Friday, and now following through today, pushing back to the upside. So certainly suggests upside or return to back to those previous highs in the upper 60s. I think that's where I would be looking for a significant amount of support, a significant amount of resistance, because that's where the uptrend stalled in July and August of last year. But I am certainly impressed with the improvement in relative strength, the momentum overbought, but overall showing renewed signs of strength. Look at the November bounce when the RSI petered out around 55. Now you have a push to new highs or new swing highs, and the RSI is more constructive. So overall, certainly setting up to have further upside potential there. Now on TMO, which is in medical equipment, so same sector difference. I feel like this is the candle show all of a sudden. I'm finding all these candle patterns, but I have to go where the action is taking me. And it's certainly suggesting some bullish candle patterns here. Do you know what this is called? If you don't, this is called a bullish engulfing pattern. Bullish engulfing patterns where you have a sell-off, you have a big down day, you have a lower open, but the close of day 2 eclipses the open of day 1. And so it's a bullish engulfing pattern where the body of the second day engulfs the range, the open close range of that first day. So Friday, a down day, with TMO nearing 600. Today, we open right at 600, but close at 625. So that's a bullish engulfing pattern suggesting further upside potential. So a lot of these charts are actually finding overall some weaker trends, but some short-term bounces could indicate a bit of a rally here. And again, those candle patterns are really not long-term signals. They're short-term signals telling you about the next day or two, really, to be honest, is what my experience has been. But overall, it's suggesting a bit of buying power coming in, could be a bounce of sorts. And then the question is that the next leg higher, or do we rotate lower? And what Steve Nissen, who I got to spend time with years ago, it's been a while since I've been able to work with him, but we looked at a lot of things, and what he would say is that the low of today, the low of the pattern, which would be 600, should be the stop. So if you suggest, or if you indicate that this is a short-term buy signal and upside potential given that bullish engulfing pattern, as long as we stay above 600 over the next couple of bars, that's a good signal. If we would break that, that's sort of a natural stop to the signal and tells you to go find your charts elsewhere. Sticking in that same one more, I don't mean to stick in this short-term chart here, Regeneron. So Regeneron's been sort of a choppier pattern. It has this big cup and handle pattern, but has to get above 680 to really validate that rounded pattern and that buy signal. I think that could certainly happen, but I would want to wait for it to get above 680 to get really interested in that. You're also getting some names breaking down. We don't have any time to really get through these in detail, but I would look at Nike just getting below its 200-day moving average today. That's after finding support a number of times at the 200-day over the last year. But note how when Nike got up to around 175, 180, it really stalled out there. It has not been able to get above there. Now you're getting the stock breaking down through swing lows and getting back below the 200-day. So certainly pay attention to that one. No more time for shifting stocks. Encourage you to use our scanning engine and some of the reports to find some individual stock ideas, but we need to wrap to today's show and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number one is the 10-year Treasury yield. We're looking at a little bit of a longer term view. You know, I find a lot of times when you look at one particular chart, and I tend to look at the 10-year yield on like a 1-year basis, occasionally like a 2-year basis, but I usually look at about a year when I'm looking at the 10-year. The problem when you do that is it looks like yields are at all-time highs, which they are for the last year, right? We broke above the early 2021 high, but looking at the last 7 years, you can see, you know, the question is how much higher can yields go? The answer is a lot higher. At the end of 2018, we were above 3% on the 10-year. There's no reason why we can't go back to those levels. Do I think that's a reasonable expectation? I don't think so. Do I think it's reasonable that yields go higher from here? Absolutely. And looking at a longer term chart like this can help you understand the longer term sense of things, right? It's not about just the fact that yields are up a lot from, a year and a half ago. It's the fact that still yields are relatively low compared to the overall range that you've seen. Chart number two is the healthcare sector. We're looking at the XLV. I mentioned some of those charts with bullish patterns, short-term patterns like Regeneron with the bullish engulfing pattern and so forth. If you look at something like healthcare, you can find that, sorry, that was TMO, I think was the bullish engulfing pattern. If you look at the healthcare sector, the XLV, you can see that same bullish engulfing pattern. Down day on Friday, up day today, it engulfs the first day's trading right at the 50-day moving average. I'm seeing signs of a tradable dip, a bit of a buyable dip. And again, that's a short-term signal, but worth noting as we think about how this week may play out. It's indicating some buying power coming into the market here going into the close. Finally, Amgen, I think it's interesting to look at a sector like healthcare when you do see it starting to improve and start to look at where you're seeing relative strength emerge. Chart like Amgen is an interesting one. On a longer term basis, it's been a pretty tough chart. It's been really sideways. And if you look, we're not far from where we were 2 years ago. And the relative strength overall has been consistently negative. But I would be interested in the fact that found support at 200, has bounced off of there in October, bounced off of there again end of November, now getting above the recent swing highs there in mid-December, and now getting above the 200-day moving average. And I think today was a nice follow-through day after Friday was closing just above the 200-day. Holding that 200-day would certainly be an encouraging sign. And I think there's certainly a strong potential to get back up to retest those previous highs in the 250, 260 range. And that's why we might be looking for some short-term resistance for sure. But I like charts that rotate into a pattern of accumulation on improving relative strength. Folks, that is our show for today. Thanks so much for joining us here on a Monday, making sense of these markets using the technical toolkit. I want to remind you to go to StockChartsTV.com to see all of our previous guest appearances. We have some great guests this week, but so many great interviews to help you make sense of these markets going forward. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.